you're still going to come back to a reasonableness standard that you can defend. Okay. All right. Let's not get too much deeper into this. We need to move forward. But final question.
Can zoning make a difference? Like if you
yes,
have farmland,
absolutely. Because you could be the only commercially zoned property within an area. Everything surrounding you is maybe residential or industrial or farmland or whatever it might be. So your land could potentially be worth more per square foot than everybody else's. Okay? It's usually, once again, it all gets down to a reasonableness standard. Okay? And a defendable standard. Okay, so getting back to this, just real quickly, we have this improvements of $8 million. So what that would really mean is you would have that $8 million that you would then divide by the 39 years. Which would mean 205,128.21. Divide that by 12 months. So that would give you 17,094.2. And then if you had 3.5 months worth of depreciation, as in our previous problem, so 59,829 versus 74,000. Okay, so I follow what I'm saying. So because of the land being 20%, that is going to lower our depreciation charge by 20%. Everybody cool with that? Okay, that's the reason I did it this way, so to show you that it has an impact. So instead of $74,000 each month in depreciation, now we only get $59,000 a month. Okay, good? All right. Okay. All right. So let's just say that this property sold for $12 million a few years later. Let's say 3 years later. Okay, so you purchased it for $10 million, you sold it for $12 million. What does that represent?
gain.
A capital gain on the property. Okay, so for tax purposes, that's what we call a capital gain. In other words, we're taking what we paid for it, $10 million. What do we sell it for? $12 million. The difference between those two, $2 million, or capital gain of $2 million. Is everybody with me? Yes or no?
Yes.
Okay, now, capital gains get treated differently, okay, in the sense of their tax treatment. That was one of the things your speaker was talking about today, is that capital gains, depending on how long you hold the property, can dictate what your capital gains tax rate is. If you hold the property for basically about a year, you're going to pay a much higher tax rate that is typically going to be based upon your regular ordinary income tax rate, which could be, 30, 40%, okay, in some cases. Whereas if you hold the property for, let's say, more than 2 years, or 2 years or more, that capital gains tax rate could be 15 or 20%, okay, depending on what tax bracket you happen to be in. But the point being is it's going to be substantially less, okay, to have it as a capital gain versus ordinary income. So now, simple thing, so if you own a piece of real estate, let's just want conceptually, ignore the numbers for a second. If you own a piece of real estate, would you prefer to have more ordinary income each year that's generated by the property, or would you prefer to have more capital gains that you would have to pay? Okay, once again, in terms of income, capital, we're talking about ordinary income versus capital gains income. Which would you prefer to have?
Ordinary income.
Okay, you would prefer to have capital gains income because it is taxed at a lower rate. Okay, whereas your ordinary income, the property generates from one year, the income that it generates from one year to the next is going to be treated as ordinary income, much like the income that you receive from your paycheck. Okay, where you get all that stuff subtracted out. Okay, does everybody follow me? Okay, so this is why that what ends up happening in most cases, if you're going to be a long-term owner of real estate, you are going to try to allocate as much of the expenses as you possibly can to your ordinary income, because more expenses means less taxable income. Okay? Does that make sense? Okay? All right, moving forward. Now, in this particular case, let's say 3 years. 3 years later, and I'm trying to simplify it just a little bit, but let's say in 3 years, and we can go by the total number of months. It's going to be, for this property, it's going to be 3.5 months for year 1. For year 2, it'll be the full 12 months. And let's say for year 3, we'll say 12 months worth of depreciation. Okay, does that make sense?
Yeah, so the half is only for the first month, and then never happens
Well,
again.
and if you hold it all the way for the full 27.5 or 39 years, then that final month would take care of that half.
Gotcha, but like for every other year after.
Yeah, it's all, yeah, you get the full year's worth of depreciation. So, in this case, over this holding period of 3 years, which is really 2 years and like 3.5 months, so 12 plus 12 plus 3.5. Oh, I hated it to come out this number because it's going to confuse you. It came out 27.5 months. Okay, this has nothing, that's just random chance, but it has nothing to do with the 27.5 year depreciation period. Let me just do this. Let me make it 4 years.
Change it.
I was about to say, you can just make it into 11 months for year 3.
Well,
No, it's okay.
but that's assuming that we're selling it.
Yeah.
It's okay.
Or we're assuming that in this, well, okay, let's do it that way. What the heck? Let's say we sell it at the end of that year, so we get 11.5 months of depreciation. So in that case, it's just going to be 27 months. Okay, simple as that. Solve the problem. Okay, now, so what that means is that for each of those 27 months, we got $17,094.02 as our depreciation. Yes? $17,094.02 times 27 months, so $461,538.54 of accumulated depreciation over the 2 years, basically 3 months. Okay, does everybody follow that? Yes or no?
So that's 17,000.
That was the monthly amount.
But isn't that the monthly amount on the $8 million?
Yes, it is. That's the new number we're using because that's the accurate number. Okay, so that amount is $461,538.54. Okay, that is, we refer to that as our accumulated depreciation. Okay, does everybody follow that? In other words, it's just, accumulated simply means we've collected it. Okay, we've gotten that much depreciation over that period of time. Yes? Okay, now, given that that's the case, what happens whenever we sell the property for $12 million minus the 10 million, we had a 2 million capital gain, okay? But we also, by virtue of having accumulated this depreciation, we now have another topic called recaptured depreciation, okay? So this 461,538.54, what we're saying, and what the IRS has basically said, is from the overall $10 million of value on the property, 8 million of it which was depreciable, we should only be selling this property from the IRS's perspective for this amount or less, okay? Because they're saying the value of this property for income tax purposes, okay? Once again, divorce the real world, come back to the tax world. The IRS is saying that this property has lost $461,000 in tax basis value, okay? That's what we call it, tax basis, okay? And so that $10 million property, of which we said 8 million was the improvements, those lost a total of 461,000, meaning for income tax purposes, the IRS is saying this is the dollar amount that you would have to sell the property at, not to incur any income tax at all. Does that make sense? Yes or no?
Is it ordinary income tax?
No, any income tax. Okay? Because it's break even. You've gotten the benefit of that depreciation over the last couple of years that you've written off of your income tax. And now they're saying this is the most that you should be able to sell this property for and not have to pay us any sort of tax. Okay, now I'm going to fry your brains just a little bit more.
Yeah.
Okay, so we're selling the property for 12 million. Okay, we bought it for 10 million. So we're saying that portion is a $2 million capital gain, probably taxed at, let's say, 20%. Okay? Everybody with me? Yes or no?
Yes.
Okay. Then we have what we are calling our depreciable value of the property of 9538 461 46. The difference between that and the 10 million is this 461,538.54, which is called recaptured depreciation, which gets taxed at 25%. Okay? So, if we sell the property for $12 million, our tax bill is going to be basically taking the $2 million times the 20% plus the $461,538.54 times 25%.
It's always, recapture is always at 25%?
Currently, yes. Okay, does that make sense? Okay. Okay.
Like, that's what she'd appreciate over the course of the year.
Okay, here, let me say. All right, so this whole idea of recaptured depreciation is as follows. The IRS, you would agree, the IRS has given you this tax write-off over the past 2 or 3 years of all this depreciation, this $461,000. They have given you that money as basically effectively saying you're not going to pay taxes on that dollar amount because you're being able to offset your income by that dollar amount each of those years for the past 2.5 years. But now what's happening is you're selling the property, and you're selling it for more than the IRS says the property should be worth. And so as a result, they're saying, we're not going to allow you to double dip in the sense that you're not going to get the tax benefit from those first 3 years and then not, in essence, have to basically pay part of that back in the form of income tax. So what they're basically doing, just to make sure that this is clear, you're getting a tax benefit over that first 2.5 or let's say 3 years that where your tax rate is maybe like 30 or 40%. And you're going to write off that income at that tax rate. But yet, 2 or 3 years later, when you go to sell the property, they're saying, we're going to now tax you on that benefit that you received, okay? But we're not going to tax you that full amount, we're only going to tax you 25%. Okay? So the point being is, they're getting their money if the property goes up in value. Now, if the property went down in value, like for example, if you sold it for $8 million, there'd be no tax liability at all. None. It's a loss.
So let's say you will sell it from what the it worth according to the IRS,
Yes.
without the cap gain.
Yeah, if you sold
So
it,
you just keep
if
your
you
money.
sold it for $9,538,000 right now,
Yeah.
no tax liability.
So when you look at both ends for the 12 million and 9 million.
No, these are added together. In other words, if you sold it for $8 million,
Yeah.
there would be no tax liability at all.
Okay.
If you sold it for $9 million, there'd be no tax liability at all.
Okay.
If you sold it for $9.2 million, there'd be no tax liability at all.
Okay.
And if you sold it for $9,538,461, there would be no tax liability. But because you're selling it for even $1 more than that, every dollar above that, above this, from here to here, the difference of this $461,000, that gets taxed. And it gets taxed at the recaptured depreciation tax rate of 25%.
But you get to keep your 2 mil.
No,
The
you
tax
you
goes
get
up.
taxed on that at 20%.
Oh, you get taxed in both.
Yes,
Oh, wow.
you add them together.
So if I bought it for $10 million and I sold it for $10 million,
Yeah.
I get taxed on?
No,
I don't get taxed.
no, okay. You don't get capital gains tax. If you bought it for $10 million, you sell it for $10 million. In other words, ignore that this happened, you sell it for $10 million, you would not be taxed on the capital gain. You would still be taxed on the recaptured
I
depreciation.
would get taxed. That's what I meant. I could still get taxed even though.
But it's for something different.
Yeah.
That's not a gain. That is simply recaptured depreciation.
Because I've already.
It gets
received-
categorized differently.
Because I've already received
You've got
benefits from the
you've
depreciation.
got to just sort of obliterate anything that makes sense or is rational or is reasonable, and just simply look at this. These are rules.
Okay.
Here are the rules.
I get it because I've already realized some benefit over the period from depreciation. So
Yep.
they're getting that back basically.
So if you sold it for 9.7, you would still be paying at the 25% on the 461.
Correct. Well, you'd be paying part of that. Like if you sold it for $9.7 million,
Right.
then you would have to calculate what 9.7 million is minus this, and then that difference times 25%. So in other words, okay, let me make this even simpler. Let me make this even simpler. If you sell it for $1 more than this amount written here, you sell it for 462.
48.
That $1 would be taxed at 25%.
So you
Oh,
get
25 cents, okay.
Yeah.
You get 25 cents.
It's a quarter.
It's not, I thought the whole thing came into
So-
account.
so right now-
Me too. I just
Okay,
the
okay.
whole thing.
So in essence, anything you depreciate, they're gonna come back after, but at 25% over the sale, profit.
Then
Over the depreciated value
Yeah.
of the property. This is what we call
Correct, but wouldn't it be more
the
beneficial?
adjusted
Yeah.
tax basis of the property.
So would it be more beneficial just because if you write off in the year of it occurred, they wouldn't come back for 25% of the depreciated value that it did.
Okay, one more time.
If you wrote it off as a be more beneficial to write off as a repair and maintenance to get the full benefit of the tax write-off versus.
Yeah, and this is where it gets interesting and sort of tricky. Yeah, I don't want to get into that, but because you can elect to not take the full depreciation, but that it's just a whole other. We want to go there. Okay, all right.
So what if you just own the land and because it's land, it doesn't depreciate?
Then in that case, you're not going to. Okay, so the simple question was, if you only own land and you sell it for more than you paid for it, it's strictly going to be a capital gain because there is nothing depreciable that would be adjusted. Okay, all right.
Okay, question, okay.
You're just trying to run the clock. I can tell what you guys are doing. Well, you
No, you just confused us. It went from, I totally get it. I don't even know what the heck is going on. Okay, so now you sold it for, if you sold it for 10 million,
Yeah.
you would minus out what the adjustable tax basis is, and then you would, that amount would be taxed at 25%. So the 461 is just the amount that you paid over the time period in tax,
Yes,
in
yes.
depreciation.
Yes. Okay, Alex.
Alright, so like, kind of back now, another kind of question. So, to get that 95, 38, to get that number, you said, so the improvement, you only do it from the improvement, which you had at 80%, and then you moved it up, but then you said it went up to 12,000 total, so that 10,000, where do you get that 10,000? Is that the improvement? No, he said it went up to 12,000, and then the 10,000 was the improvement, 8,000 was the original improvement, but then it went to 12,000. So then what's the improvement? Not 80%.
Okay, that's it.
No, the improvements are at 80%. The land is still at 20%.
Okay, so we go down again?
Buy and sell.
I probably don't. So that 10 million minus 461,000, what's that 10 million?
This is the original purchase price. Purchase price for land and improvements. Okay, this is sale price later.
Yeah, but I don't get what number. Okay, I don't.
Yep.
When you're calculating then your tax bill, your capital gain would be the 2 million times 20%, that would be the amount due on the capital gain. But on the recapture thing, I'm not following that. It's 461 times 25%?
Correct.
Right, but what happens if you sell it for $1 over?
It would be, if you were to go $1 over, you're first of all not going to have any capital gain.
Right.
And then the $1 over is going to be taxed at 25%, so 25 cents.
Just $1 over.
It's different.
That's
This is the difference between this and this. The difference is it's 461.
Taxing the
Oh, so if you, I see what you're saying. You wouldn't have had.
If that were the depreciated basis. If I'm understanding what you're asking, yes. Well, not exactly because it all hinges on what this number is.
So it's always 25% of the tax.
Yes. Okay. All right. All right. So obviously what's going to happen, I'm going to finish up the material today. Sadly, we're going to have the quiz at the beginning of class next session. I don't like that, but this is the only way. Well, I don't know any other way around it.
So next session, is there
We have the test. The first test one.
originally?
There was not.
Oh, so now we have a test and quiz.
Yes. Okay. Okay. So let's just refocus, get back to this. So now we're not going to have to run. You run the clock out. Okay. So
Okay, can we go over there?
let me finish the material first. Okay. All right. All right. Now, let's say that we've got this situation of where we've calculated recaptured depreciation.
That's a new problem or
No,
that's-
we just did that.
Okay.
Let's say we've done that. Okay. And then we've got the situation of where we've got a property. Let's say that we've got an NOI of, let's say, 700,000. All right. And then off of that 700,000, we have, let's say, interest expense of, let's say 400,000. And we have depreciation each year. In this case, let's say, for this particular property, let's say, what was it? 205, 128. Okay, was our depreciation for the year. All right, so let's see what that leaves us with in terms of taxable income. I'm going to explain this here just in a second. Okay, so that leaves us with taxable income of $94,872. Now, for most of you, if not all of you, this is the first time that you may have seen this particular calculation of taking net operating income, subtracting out interest expense, not mortgage payment, but interest expense, which we're going to talk about here in a second, and then subtracting out depreciation to get our taxable income. Now, once we've got this, and we're going to come back and I'm going to explain each of these here in just a second, then we're going to multiply that by our tax rate, and let's say that's 28%. That means our taxes payable is going to be 26,564 and 16 cents, but 26,564 is our taxes payable, or income taxes payable. Okay, for that year. Does that make sense, everybody? Yes or no? Okay, now, so what would happen is, ordinarily, whenever we look at the operating statement, we've got net operating income, we're subtracting out annual debt service, which gives us before tax cash flow, and then we sort of have stopped there. Okay, now what we're doing is we're saying, okay, we've done all of that, but then we take and we insert from this little subroutine income taxes payable. I'm just going to call it ITP for abbreviations. So income taxes payable. Subtract that out, and then that gives us the after-tax cash flow. Okay? Does that make sense conceptually? Okay? So in this case, our net operating income is the 700,000, but we're going to have an annual debt service for a mortgage payment that is probably going to be greater than this interest expense, unless we have what kind of loan? Thank you for knowing the answer. Okay. No, I appreciate that because several people didn't. If we had an interest-only mortgage, then the 400,000 could be just transferred over here. But if we had a normal mortgage, it's a regular constant payment mortgage or constant amortization mortgage, or with normal mortgage payment, you're going to have both principal and interest payments each month. So that number would be higher than 400,000. But for the purposes of this problem, and for simplicity, we're going to make the assumption that it's an interest-only mortgage. I'm gonna actually write that here, interest only. Okay, of 400,000. All right, then that would give us before tax cash flow of 300,000, of which then we would pay 26,564 income tax payable to give us $273,435 and some change. Okay, does that make sense? Okay, now here's the thing to try to wrap your head around just a little bit. This one line item, the income taxes payable line item, the only way you get to that number is having to do this subroutine, this sort of separate set of calculations, okay, to come up with that number that gets inserted here, okay? And so what you're finding, in simplicity, as simple as I can make it, you only, for tax purposes, you only get to deduct the interest portion of your mortgage payment. Okay? You only get to deduct the interest portion of your mortgage payment. And then for depreciation, that is going to be then based upon all these previous calculations that we just did. Okay? Is everybody cool with that? Okay? Then, after doing all that, that gives us this taxable income number that really is, that's the number that matters with respect to, that is the amount then that we are actually going to pay taxes on. And so this is the hard number that we write a check to the IRS for this year, is that $26,564. All of this other stuff is for internal calculations to get to that number. Okay? Does that make sense? Okay? Now, one other thing to sort of point out. Hopefully, you've been paying attention and you're following along, you're keeping up, that you realize this number theoretically could be inflated based upon what decisions that we made up front in terms of the allocation between land and improvements, and depending on whether it's a commercial building versus a residential building and all of those sorts of things, that impacts this number. Okay, so theoretically, there could have been a scenario if we tinker around with it long enough and try to maximize our tax benefit, that we could actually lower this taxable income number here to zero, which is part of what he was talking about today. All right, getting that number as close to zero as possible so that you don't have any taxable income for that year for that property. Does that make sense? Now, another thing that would help to lower your taxable income on the property is you include more expenses on the property. Okay? Now, what you will find, especially with owners like himself, smaller investors, you've seen it over and over again, you try to write off everything you can possibly write off. You try to write off your vehicles. You try to write off, you know, any sort of travel expenses, any sort of expense that would be tangentially related to the management and oversight of those properties that you own. You know, any sort of business lunch, you try to deduct half of that. You try to, I mean, everything you possibly can to attribute it somehow to that property so you can get that number as low as possible and not have to pay income tax on it. Does that make sense? Okay, and there are many legitimate ways to effectively accomplish that. Okay? But now part of what he was also saying is, you know, if you can accomplish that and maybe even get it to the point of where you know, you actually get to be a negative taxable income, then what you can do is then begin to then offset other income that you might have from other lines of business. Like, for example, you know, if your job being, let's say, I don't know, you're an attorney or whatever, you're earning a couple $100,000 a year, you know, in that job, you could potentially use some of this to offset some of that income so you wouldn't pay as much tax on that income. Now, this is where real estate becomes what is referred to as a tax shelter. Okay, you probably have heard that term before. And what it in essence allows people to do is if they are active participants, meaning that they are actively involved in the management, in the oversight of the properties that they own, then they can potentially use that income or those tax benefits to offset income from other professions. Well, the part that gets really useful is that if you can actually take a tax loss on this, you say, well, why would you take a loss? Because you're still owning the property. You're gaining ownership of the property. Okay, it's not a real loss, it's a paper loss that then gets to be transferred over to other income that you may be generating from other sources to lower your overall tax liability. This is why virtually, every reasonably wealthy person owns a little bit of commercial investment real estate, is because there are many opportunities to be able to shelter income in those activities. Professional sports stars, making millions of dollars a year off of their contracts, are saying, we don't need all of this money to live off of, hopefully, and take some of that money, plow it into real estate, and receive some of the tax benefits, from that ownership structure. Okay? Somebody had a question.
That's if you maintain the property yourself, correct?
You have to be actively, actively involved, okay? And it's going to be a situation of where, like for example, he very, very clearly made out, he is actively involved in the management and the oversight, receives the phone calls, goes and does, a lot of the work, himself. No question, he is an, active owner. Now, if it was a situation, let's say, that he had hired a property management firm to do everything, and literally all he was doing is, sitting back collecting checks every month, okay, and depositing those checks into his bank account and writing checks.
Yeah.
That's probably not going to be classified as an active participant. Now, once again, everybody says, well, how do they figure that out? If they audit the situation, they're going to say, okay, well, who's collecting your rents? Who's going out there, and talking to the tenants? Who's doing this? Who's doing that? And if all the responses come back, well, it's my property management team. It's my property management team. It's my property management team. Then the IRS is going to say, well, you're not really an active participant in this, are you? You're not? Okay, well, all those tax deductions you've been taking against your other ordinary income, not going to happen. Okay? All right? Thoughts, questions, observations up to this point?
You can own your own property management team, though.
Yeah, you could.
So that's
But once again, you have to show, active participation and involvement, okay? It can't just be a complete sham, okay? Or even a partial sham. It needs to be, it needs to be legitimate. Okay, let's see. Hold on. All right. Okay. So, one of the things that we just said that you get to take the interest expense only. Okay? So, what if we have a $8 million loan this is separate, $8 million loan at 7% interest rate for 15 years. Okay? Now what we want to know is how much interest expense would we have in the first year, potentially in the second year, and so forth, so on. So, put this into the calculator as follows. 12 payments per year. Okay? And clear everything out. Then we would have $8 million as our loan amount or our present value. 7% as the interest rate. 15 years as the term. than we would initially solve, just like we've always done for the payment amount, okay? So we do that real quick. Okay, so the monthly payment, 71,906.26, okay, would be our monthly payment for that particular loan. Now, what we are able to subtract for income tax purposes is the interest portion of those payments. Okay, and this is where we get into using the amortization function of the calculator. So what we're going to do is we're going to say, okay, for month 1 through month 12, so 1 input 12, we want to know the amortization for that particular period, okay? So when we put this in the calculator, what it's going to do it's going to give us $312,783 as the principal, $550,091 as the interest, and then our balance at the end of that first 12 months or first year, $76,87,216 would be our balance. So which of those three numbers are we going to be using?
Interest only.
Interest only. So what we're saying is if that were the loan, that would be the dollar amount that we would be able to write off as our interest expense. Does that make sense to everybody? Yes or no? Okay. Okay. But our payment per month is the $71,000. So over the course of the year, if you want to sort of think of it, 71,906.26 times 12. So let's just sort of put it like this. $862,875 would be principal plus interest over the course of that year. And then the principal portion that year would be the $312,783, and then the interest portion that we're actually writing off and that we're concerned with is the $550,091. Okay, does that make sense, everybody?
Yes.
Okay. Now, once again, let's make sure you're listening. What do you get to write off? You get to write off the interest expense, you get to write off the principal, or do you get to write off the entire payment? Interest. Interest only. Okay. All right. Moving forward.
This is also quick.
3. Okay. Okay. So, all right. So let's say that we've got before tax cash flow for a property and after tax cash flow for a property. We'll keep it relatively simple. So let's say that before tax cash flow we spent $500,000 on the property. The same sort of thing is going to be true with the after-tax cash flow. That's how much we're spending. But now, for each year, we're going to have our before-tax cash flow, and let's say that our before-tax cash flow for this year is going to be, I don't know, $60,000. But then, after taxes and after everything has been sort of subtracted out, maybe we're left with $40,000. Okay, and we're just going to, just for simplicity's sake, I'm going to make these numbers the same. For each year. Now, granted, they're not going to be the same for each year, but just for the purposes of a simple explanation, they're going to be the same. And in the final year, we're going to sell the property, And on a before tax basis, let's say that we walk away with 560,000 all told, just basically the original 500,000 plus the 60,000 for that year. And then for the after-tax cash flow, we've got to take into account the recaptured depreciation, we've got to take into account the capital gains and so forth. So let's just say that we end up with about, well, we're going to recapture depreciation. So let's just say that it's going to be about 400 and, let's just keep it simple, 440,000. All right. Now, what we're going to ask you to do is I want you to calculate the before tax internal rate of return. I want you to calculate the after tax internal rate of return. So those are going to be two different percentages. Then you're going to calculate the effective tax rate. Okay? And to calculate the effective tax rate, the formula is 1 minus the after-tax IRR divided by the before-tax IRR, and that is going to give us the effective tax rate of the difference between these two. And I'm going to explain that here in a second as we go through and we calculate. Okay? So you should know how to do this top part pretty easily. So once again, 1 payment per year, 500,000, cash flow, 60,000. And I get 12%.
How did you get it? How did you get this number?
Okay, I get 3.24%. Okay, everybody get that? All right, so what you're going to be doing, you're basically going to take, in this case, the 3.24 divided by 12, okay? Which is 27%, and then 1 minus the 27%. You're going to end up with 0.73 or 73% as our effective tax rate. Okay? That was a pretty hefty one, okay? Because what I did was I probably subtracted a bit too much on the back end for the resale price, but the point being is that's how you do the calculation, okay? And so all this is really saying is, another way of looking at this, you're getting to keep basically 27%, and you're having to, of your return, you're having to pay out 73% in taxes. Okay, does that make sense, everybody? Yes or no?
So this is just measuring how much of the return is going back.
Correct. Well, or this is specifically, this though is our effective tax rate. That's how much we're paying in taxes relative to the comparison of our before tax cash flow and our after tax cash flow.
On average per dollar.
Right. Yep. Now, just so that you know, in the book, there is another worked out example of this in chapter 11, which is the chapter that covers all this material. And in the newest edition of the book, specifically the page number for this is page 378, exhibit 11.29, cash flow summary. And then right below that, calculating effective tax rate.
What page again?
Okay, once again, page 378 in the newest edition of the book. But if you've got an older edition, just go to that chapter, look toward the end of the chapter for effective tax rate. I would strongly encourage you to do so. Okay? All right. Other thoughts or questions? That pretty pretty much got us through, I think, everything we need to do for this little quiz. Oh, I left out one little thing. Make sure I don't cheat you. Okay. We'll keep this simple. So let's say we've got the before tax cash flow of 200,000, and the original purchase was 1,500,000, financed with 75% debt, 25% equity. Calculate the equity dividend rate. Okay. Calculate the equity dividend rate. Now what that means is, what is my return on equity? My before tax return on equity. So what that would be is your before tax cash flow divided by the equity. Okay, so in this case, we know that our before tax cash flow is 200,000. Yes? We're given that. Okay, and our equity would be taking the 1,500,000 original purchase price, oops, 3 zeros, and multiplying it by 25%. So 375,000 would be the equity that we have in this project. So our equity, or our before tax return on equity, or our equity dividend rate is simply going to be 200,000 divided by 375,000, or a whopping 53.3%, which everyone would be very happy with. Okay?
Wait, so it says the BTROE is like before tax return on equity?
Correct.
375 is your initial investment.
Yes. Okay? So that covers everything. Now, here is what I would suggest you do. Okay? I have covered everything that's going to be on that quiz. I would suggest that you take advantage of this rare and unique opportunity to be able to study not only what I covered, but I would go back and try to match up what I covered with what is in the textbook for Chapter 11, okay? Because it's all there, okay? And that would help you to kind of refine the points that you are not quite certain of, okay? And then we will start with the quiz, okay? And then that will be the very first thing we do in the class session. Now, hold on a second. So the plan is we're going to do the quiz next week. Then we'll have whatever, I think, new lecture that we've got. Then we will have the test. Okay? Does that make sense? Okay. You are going to be in this room for the law class, even though it doesn't say that, because